Hello guys and girls, and welcome back to another episode of Quick Tips. So in episode 4, we're going to be talking about valid trades. So myself and the coaches have been having a lot of in-depth discussions about what we believe will be the bridge towards that consistency, what will bridge that gap towards more people becoming consistent. Is it just people taking too many valid trades or trying to catch too many falling knives? Now, what our aim is in this particular episode is to show you what type of trades to look out for. Trades that are just valid and trades that are valid but in great areas. Sometimes we look at structures that they're a valid structure, but it's not really a valid trade. So I think you're going to find that a lot of the times, for those of you that are struggling to become consistent or doing the break-even dance, that you're just too zoomed in. So there's going to be a lot of key details in here to help you out moving forward so you can start adjusting your plans, adjusting your go-to setup. So I'm really looking forward to getting into this episode, and I highly recommend that you take a lot of notes. So firstly, before we get into it, just discussing the valid versus high probability. Firstly, we want to associate a good connotation, a positive connotation towards the word valid. I mean, just even in tonality, if I was to say it's valid, but it's not high probability, we almost start to associate the word valid as something that's not good, when the truth is, valid is still good. So see valid trades as good. You just want to have your ratios correct. So if 80% of your trades are high probability and 20% are valid, perfect. You know you've got your ratios correct. Because the reason why we have our valid trades is more towards to do with the hedge. We want to make sure that we're not moving too much in towards that, perfectionist mindset, and we're thinking in probabilities. And it's really important that we have that, because if we only waited for high probability, we'll constantly be waiting for perfection. And that is the quickest way to just wait, and never actually be within the market and take trades. So let's get into it. So what do we have first? Well, the first point we need to understand is this. We have valid structure, not valid trades. So this is what I'm going to show you on the charts. And essentially what you're going to see with this is it's a valid pattern, but it's not in a valid area. And when you're too zoomed in, you end up taking these trades. And this is normally for you new guys and girls, you get caught into these positions because you're too zoomed in. This is going to help you out a lot. The second part is going to be valid structure versus valid trade. So essentially, this is the same type of structure, but in a valid area. So this is going to show you what a good valid trade actually is. And the third part is moving towards valid structure, high probability trade. Now we're going to touch more on high probability trades in part 2, which is going to be episode 5. But in this episode, I established just to show you as many valid trades as possible, so you actually realize there are some really good valid trades. It's just understanding the bigger picture and the higher time frame is going to help you out massively. So let's get into it. So first up, we've got euro dollar. So do we think this is a good trade? That's the question that you want to ask yourself. We have 1, 2, 3. We come from an impulse. Now you might be thinking you're a little bit zoomed in. Well, the truth is, this is how a lot of people are operating within the markets. Now, if you're a bit more experienced, then you might think that's a little bit silly, but you have to understand we was once there where we were far too zoomed in. So do we see this as a good trade? We've got 1, 2, 3, descending channel, overall big continuation type structure. It's not the cleanest pattern, descending structure within there, and even a retrace. You might have even got caught into this trade, taking in a risk entry around here, or even had an entry just above. So looking at it at that point, do we think that's a good trade? You can see how people get caught out into these trades a lot. So this is a prime example of a trade that is at a valid structure, but it's not really that great of a trade, and I'll tell you why. When we zoom out, go to the 4 hour, suddenly look at it now, where are we? Then you look at the overall bigger picture and say, well, there's a big channel there. The reason why we're looking for upside is because we've got an impulse and we're expecting some sort of continuation, but then we get this type of larger pattern. It doesn't really have too much structure to it, but too many people are getting caught into these type of trades very easily. Rather than looking for a flat flag of continuation, they're just looking at this picture and being far too zoomed in. And this is how you're getting caught out, because you're trying to catch a falling knife on something that doesn't really have structure. You're just attaching trend lines to it. Now, if it had more of a impulse, correction, and a double bottom within it, and you're looking for continuation to the upside, because I can see why you might be looking for continuation. It's the same type of structure, but it has a slight variation to it. So just a tiny little tip. It may meet with the trend lines, and this is more for beginners at this stage. It might meet with the trend line, but it doesn't necessarily mean that's a trade that you should take, because this type of structure isn't really one that plays out that often. 1 in 10 or 2 in 10 that it plays out, you're much better off waiting. If you're going to take something like this, wait for the structure to be in a better area. You could take that price and look at something here. Now, at this point, we didn't really get an actual entry point to buy this, but you can see 1, 2, 3. You're better off waiting and zooming out. So next time you look to take a trade, a great tiny little tip is to just zoom out. Just that 3 seconds. It can be the best habit you can make. Before you now take any trade, make that decision first. Right, I need to zoom out first because I just want to check the structure, rather than quickly going to your deal ticket and filling it out straight away because you feel like you want to be in the market or fear of missing out. There's emotions of wanting to get into the market. Make sure you zoom out first so you can see whether you're actually making the right decision. So that is euro dollar. And one thing I want to cover very quickly is this. We have to understand the 3 parts I mentioned in the intro. So firstly, we have our valid structure but not valid trade. So what would that be? Well, let's take a look at, for example, we've got this double top area here. This is what you would call a valid structure, valid trade, right? We're at a double top. This is a great area to look for a sell. Let's say, for example, we take a bit of price. We can take something like this. Take a bit of price, and we're looking to sell this, right? Let's say we're looking to sell it. If we're looking to sell this area, and we've got something like this, that technically, and this is a great tip, and this is where a lot of people get caught out as well. These are just tiny, tiny little tweaks. They might seem obvious to some of you, but yet we still make these mistakes. So if we take that structure, this is a valid structure, but it's not a valid trade. Why is that? That's the question you want to ask yourself. It's a valid structure, but it's not a valid trade because it's not supported by any outer structure or a double top or anything like that. It's an ascending formation. It's a rising wedge formation, but it's not in a valid area that you can look to take it. Now, sometimes, yes, these can reject and they play out, but if you constantly take trades like this just because the structure is valid, it doesn't mean that it's a valid trade. Now, when you change that and you move that price to here, suddenly that's gone from being a valid structure, not a valid trade, to a valid structure, valid trade, just by putting it in the right area. And you might think, well, that's an obvious, I wouldn't take that type of trade. But yeah, but if you're new, or sometimes even people that are not new, sometimes when you're too zoomed in, you then end up taking those trades. You look back, you do your advanced self-review, and you realize, oh, why did I take that trade? How many of you are guilty of that, right? Myself included sometimes. You make tiny little errors. But if you make too many errors, then that's where you start doing the break-even dance, and you get in towards the minus. So it's just making that little tweak to zoom out. That is the key thing. So it's looking at exactly the same price. You're looking at exactly the same structure, just sometimes in the wrong area, and just being a little bit more patient with it. So remember, you have your valid structure, not valid trade. Then you have point 2, which is valid structure, valid trade. And then you have point 3, which is valid structure, high probability. And that's what we'll move into in the next episode. So that's euro dollar. Hope that helps. Let's take a look at the next position. Now moving on to the next position. So here we have Aussie dollar. Do we believe that this is a good trade? Is this a valid trade? Is this a take that you guys and girls would take? Let's take a look at it. We're right at the outer structure. We have this 1, 2 here, this outer structure meeting with here, and we have this descending type formation. And then we have the 1 hour retrace essentially is closed here, right? Would this be a trade that we could take? Well, let's see how it plays out. It's got a lot of the criteria that some of you might get. So you tagged in, and about 6 hours after, you're then tagged out. This is a prime example, then it moves up eventually. This is a prime example of trying to catch a falling knife. Now, why is this a trade that you can take, but sometimes you want to avoid? I'm going to show you another position after this, which is one that is more in line with a high time frame that's going to help. Now, if I zoom out, we go to the 4 hour just to look at the overall structure. This is a trade. This is a typical example of trying to catch a falling knife. So at that point, we could argue and look at it and say, well, it's a big descending structure. We've got a descending formation. We have a descending within it. We have 1, 2, and then we're looking for the third touch there. That's definitely valid. That's definitely a good trade, but is it a trade that you want to take over and over again? There are better trades that are valid trades, valid structure, that are supported more by the higher time frames, that gives you that tiny little edge, and it's just that tiny little tweak that you need to make. So looking at it here, if that same structure was of course at the low here, that would be a different story. But this is just a prime example of it's just trickling its way, trickling its way, trickling its way. So what can you do to avoid that? Well, essentially, first, you can make the decision within your plan that if it's not supported by a high time frame structure, so let's say something like a clear impulse, and then it's an overall bigger continuation like this, and then you're looking for, let's say, a third touch with more of a clear impulse correction and a move to the upside. This is just a descending formation. This can last for ages. This could just keep trickling, keep trickling, keep trickling. It's not really supported by anything, if that makes sense. And this is just a bit of volatility. So structurally, it's definitely valid, but this is just a prime example of trying to catch a falling knife. And if you keep trying to catch too many of those, you'll constantly be thinking about, well, that one that does play out is the one that makes you, let's say, 7%. So you keep trying to catch those, but it's not a sustainable way to trade, and it's very emotional as well. So better to avoid those. And even when we go to the 15-minute chart, if you was to filter that, and I know some people were looking at this trade, if we go back to it at that point, you're looking at the trade, it meets the criteria for sure. You've even got this tiny little double bottom within it as well. So you can see right at the structure there, just as we break, we've got a little arc, the little double bottom, you're tagged in and tagged out, right? You might be getting with about a 15 pip stop. That's fine, it's below the low. You get your target here for about 2% firstly, and then nearly 5%, and then so on if we break to the outer structure. So it's just a tiny, tiny little detail, and then you're tagged in and then tagged out shortly after. So you can see how these trades play out, and the best way to avoid them is literally just to wait. It's this need to want to be in the market. As you can see, it played out a little bit better after, but you're better off in these situations. If it's not really supported by a high time frame structure, well, what can you do? Well, you just wait. I know it might sound simple, but you just wait. Wait for the first impulse. So write that down in your plan. Wait for the first impulse and then take the next correction. And if we don't get that, that's fine, because the majority of the time, it's a trade that doesn't really play out in your favor anyway. This just moved up correctively in the end, but over the majority, they're normally the ones that don't play out anyway. So you're better off to zoom out, ask yourself, have we had the first impulse yet? This is, if you feel like you're trying to catch a falling knife, it's probably true, right? So sometimes it's better to just wait, make the decision after and say, right, I'm going to wait for the first impulse, then take the next correction. If it's within your plan to take these valid trades in these areas and you're more aggressive, that's fine. But for you as a trader, like the majority of us, we're not that aggressive. So don't try to copy somebody else's type of style. Be true to your style, and that's the most important thing. So I hope you took a lot of value from that, because this is a typical trade where you're caught in, caught out. And if you take, 5 or 6 of these trades a month, then guess what? No wonder you're emotional, because you're constantly trying to catch the bottoms and the tops of essentially trades in no man's land. They're nothing really. They do have a bit of structure to it, but this trade, there are much better trades, and I'll show you in the next position. Let's take a look. So here we have our next trade, which is New Zealand CAD. So as you can see, similar type of structure. This is more parallel, right? This has a bit more structure, as you can see, evenly parallel here. We have 1, 2, 3. Looking for this area here, got a descending channel within here as well. And this has some element of it, which is trying to catch a falling knife as well. But again, there's nothing wrong with taking them. It's just you want to have the higher time frame structure to support it a little bit more. So as you can see, you've got the descending structure on. Let's see how it plays out. So we go a little bit lower, it breaks, we're looking for the retrace. Fine, so we've got a bit of retracement within there now, right? So essentially you can set the order either within a risk entry within here or just on the break. Now at this stage, what decision can you make from what you've just learned from Aussie dollar? Well, you can say, well, I'm not going to try and catch a falling knife. I'll wait for the first impulse and I'll take the next correction. Or if it's within your style, I'll take this one. So what do we get? So we break out to the upside, like so, and some of you would have taken that trade. We're waiting for the next correction. As you can see, the little continuation, and then we move to the upside, right? So you can just wait, impulse, correction, continuation, rather than constantly being, because you can be tagged in, tagged out, tagged in, tagged out, and it can keep trickling its way down. So what was the key difference? What would make this more favorable than the Aussie dollar position that we just saw? Well, let's zoom out. This is an important thing. The reason why I'm zoomed in is because this is how majority of people are. So if we look at it here now, I can say, well, at this point, we wouldn't have had that trend line on here because we wouldn't know that that's the angle, right? We wouldn't know that's the angle yet. We could have a rough idea because we've got this structure, 1, 2, 3, 4. So we have a tiny idea why we would have the angle, but it's not exact to know that it's going to reverse from there, right? All we know is that we broke this low here correctively. So we ask ourselves the question, how did we break? Well, we broke in the form of a descending channel correctively. So there's been no progression, so we could springboard to the upside, or create a running channel and drop, which is what we might be creating now. So we knew those variables weeks ago, and it was about establishing, do we want to pick this reversal point? We can, it's just understanding the risks. So what's the key difference? What helps us with this? Well, if we go to the daily chart, the reason why I would say this is more favorable, and this is a tiny little tweak that will help, zoom out and ask yourself the question, where have we come from? What is the high time frame showing me? Well, in Aussie dollar, we had that wick and it was just a big sideways price action. What do we have here? This has more of an impulse, more of a solid continuation. This is a pattern that we recognize very clearly. It's just a very clear expanding formation. You can find loads of these, right? So at this point, we have a much clearer pattern, has a high probability, where Aussie dollar was just sideways descending structure that could just keep trickling its way down forever, followed by a bit of volatility that moved to the upside, right? Where at this stage, we actually have a solid impulse. We actually zoom out further, and we come from a bigger descending structure that you could argue this is the middle section to then eventually impulse correction and could move to the upside. So this is supported by a much higher time frame structure, and we're looking for a completion of the pattern. 1, 2, 3. So as you can see there, both of them essentially do come into the category of trying to catch a falling knife. I would completely agree. But this is more favorable because of these reasons. Because on Aussie dollar, we're not expecting a completion of a pattern. It's nowhere near as clear. This comes from an impulse. This has a 1, 2, so we're expecting a third touch. So you can see why that this has more favor to it. So a tiny, tiny little tweak, yet it changes everything. So I hope you can see just by making those little differences, it helps out massively for your entry points. So moving on to Kiwi dollar, do we think this is a good trade? This is a prime example of where people get caught out. Well, let's take a look. You've got this falling wedge formation. As you can see, nice clean structure. We're close to the outer structure. We could put our entry here, and we could do two things. We could have our entry just below this low because we could get a breakout, or we could have it below here. Now, if we have it below here, what's the downsides and what's the good sides? Well, the good side to it is that we could catch the trade and we've got our stop protected below here just in case it keeps trickling its way down. Well, if you create a bad habit of that, you'll constantly see price, let's say, up here, and you'll do the same thing. You'll constantly justify, well, I'm not going to be by the charts, so I'm going to do this, and before you know it, you're setting entry points just here just to get into the trade because you have the fear of missing out. So this is pretty much a FOMO trade. So essentially, let's take a look. If you did take this trade, it's close to the outer structure. It's a valid structure, but it's not a valid trade. If you took loads of these, you'll constantly be tagged in, tagged out, and taking losses, and it's very emotional. So as you can see here, this one tags you in there, and this one plays out. And this is the worst thing that can happen because you'll take a trade that actually does play out, and you'll start to put these type of trades within your plan. Now let's take a zoom out. Let's have a look. So as you can see, we're looking this on the daily. 1, 2, 3. We're looking at the outer structure. We have the descending formation. We're looking at this as an impulse and a big continuation to the upside. Right, that makes sense. But at the same time, when we go to the 1 hour now, as you can see at that point, that was pure fear of missing out. It was very close. Yes, this one played out, but if you constantly do that, you'll forever be tagged in and tagged out. And the worst thing you can do sometimes is actually win on the trade, because then you think that's a great thing to do, and then you constantly take more of them in hope that it's going to be that one trade that banks you that extra 7 or 8%. But really, it's just a bad habit of taking those trades. So essentially, looking at the type of position, if we were to adjust it ever so slightly, take that same price action and put it there, that goes from being a valid trade, not a valid structure. You can put that back there. So this can go from pretty much like this. You can see the structure there, and you take that from here. Now that's gone from a valid structure, not a valid trade, to a valid structure, high probability trade, just by taking that same structure, being a little bit more patient and waiting. And the majority of times, when we're patient, we do get those trades. So the key thing and the key difference is it looks exactly like the trades that you're taking. But what a lot of you are doing is that you're getting in too early, and it's just fear. It's fear of missing out. It's the need to be in the market. It's the need to want to trade every day and make money. A lot of these emotions. But when you can back test and you overcome them just by understanding these details, it's going to help out so much in your performance. I promise you that. So yes, this one worked. But what could you have done? You could have just waited for the first impulse, like I said, and taken the next correction. Now this one you probably would have banked, 2 or 3%, etc., because you probably wouldn't have held through this pullback. You would have got taken out after this and moved to stop, etc. But overall, as you can see, you could have waited, right? And on this one, if you got tagged in and tagged out, you'd look back and say, well, why did I take that? It wasn't the outer structure, it was the fear of missing out. So looking at a trade like this and sometimes thinking that you've done a good job is the thing that you need to analyze to make sure you're not making awful mistakes. And going back to the first position, what did I cover in euro dollar? Looks very similar to this type of price action, doesn't it? Something that has a bit of structure to it in terms of we're expecting an impulse and a bigger continuation. And what do we get? It's taking a trade like this, right, that might look valid, if you like, when you zoom into it, like this. You're zooming in here, and you're just seeing this part of it. You're just seeing the move up, 1, 2, potential third touch, taking it here, a little bit corrective. I can take a buy here. But if you look at it, it doesn't really have any kind of structure to it. And what you'll see when you backtest, you'll very rarely find continuation patterns with such a big scoop, a big gap like this. This has more of a double top type feature. And these ones tend to, when they do this, they tend to just keep trickling their way down rather than them forming a clean structure. You're more so looking for things like that have an impulse and more of a double bottom type formation with these type of corrections. Or if it comes back down, it'll have a third touch like this, and they're normally parallel, not this kind of price action. Very rarely you'll be taking flags like that, but it's valid because you'll see 1, 2, 3, and you'll take that type of trade. And when you're too zoomed in, you're just looking at this, but you can now understand why that didn't play out. It's not really a pattern that we recognize or trade frequently, and it's not one that is probable. So it's just by understanding that key difference. We're all looking for the buy. Is this a great trade to take? I wouldn't say so. It's valid, it's in a valid structure, but it's not a trade that you want to put in your plan. When you see something like this, go and back test it. I highly doubt that you'll find many of them that actually play out with this type of formation. It's exactly like the euro dollar one, and it just keeps trickling its way down. Very similar structure actually that's played out. So that's New Zealand dollar, very similar to the euro dollar trade. Let's take a look at the next one. So let's take a look at these last two. So we have pound Aussie, and we're going to be looking at euro Kiwi. Very similar trades, and there's a key lesson in this. So firstly, we take a look at this trade. Do we think this is a good trade? What do we have? We have the double top here, we have the ascending formation, and we have this impulse correction, impulse up, and the rejection, right? Is this a trade that we'll take? This is actually a trade that I did take, and I know quite a lot of people took this trade as well. Do we think this is a good trade? It's not at the outer structure. We do have a double top within here. We have an ascending formation. We do have essentially 1, 2, 3, 4 touches. Is it a trade that we'll take? And we also have 1, 2, and we can play this to at least the bottom of this area, maybe a little bit more. Well, let's have a look. We play out, and then we even break the low, we retrace, and we bank a bit of profit. Let's actually now zoom out and take a look at the overall bigger structure. Well, if we look at the bigger structure now, what did we have? This is just a bit of volatility with that big spike, so we can ignore that, but essentially we have 1, 2, and we're looking for this area here, right? But at this point, we're not at that structure, and even if we were to adjust that and use this angle because we had a rejection, right? Even if we were to look at that from the high time frame, look at the daily, are we at the top of the structure? No, we're not at the pure high probability. We're just in this area here. If we go down to the 4 hour and we look at the structure, what does it have? It almost resembles an impulse up, and it has a type of continuation feel to it. It almost has that impulse and correction move to the upside that could go up for one more, create a double top, and then drop. So what was the key difference with this, making this a great trade? It's valid. It's definitely a valid trade that I would take over and over and again. Why is that? Well, what do we have? Impulse correction could go higher, but then we have the running channel. We have the ascending formation at the end of it. We even have the 4 hour retrace there. We have the double top. And then if we go to the 1 hour chart, we can utilize pattern separation. And if you were to look at that structure after that rejection, what do we have? It's a very, very clear running channel and a move to the downside. So you can see how this is a trade that you want to take. And if you're constantly waiting for, you're looking at the overall move thinking, I don't really want to take that. We've got the double top. We're near the outer structure. We have the ascending formation. We have the running channel. If we can get it to break even, we can manage our risks. These are the good trades to take. It's not at the outer structure. But again, if you're constantly waiting for that, it's too much perfection. These are the differences where I feel like people are either just getting in too early for the sake of it. So they're getting in areas here, for example, when it's not really at a double top, or when it gets to a double top, they still don't want to take it because they're looking at something like this and saying, well, I'm a little bit put off because there's an impulse there. Well, ask yourself the question, 80% of it, what is it? Is it corrective or impulsive? Okay, it's corrective. So if 80% of it's corrective, then it's still a correction. You cannot let one impulse candle put you off because this is a great trade. So key example, tiny little tip. When you zoom out, you can easily put yourself off, but you can see why this trade played out. It meets the criteria, and eventually it played out with the running channel. So that's Pound Aussie. But let's take a look at the difference on Euro Kiwi, because there's a key lesson here. So looking at Euro Kiwi, see, this was a trade that a lot of people took in the community. This was a trade that I actually took as well. So what do we have here? We've filled the wick. We have this overall double top formation. So of course, having our stop just above there gives us really good protection. We have the ascending formation, and we have 1, 2, 3. We also have the middle section. We even have an impulse, a correction, an impulse up, and we have an ascending formation, and we also have a retrace candle here. So as you can see, got that ascending nature. What more do we want, right? We can look at that and say, well, I'm going to be put off. Well, if I was to apply that same logic on Pound Aussie, we wouldn't have taken the trade. You see? So it's understanding that one impulse candle shouldn't put you off. Statistically, it shouldn't put you off. Not just because it shouldn't put you off. The data suggests that. So when we're looking at something like this, it meets the criteria. We take the trade. What happens? Well, let's see. We start to play out. Some of you might have had a line in here where you actually didn't get triggered in. Some of you may have got in a little bit earlier, like myself on the 15-minute chart. So as we play out, corrects. Even at this point, you could still have an entry on because that could have broken at any point. Some of you might have even had an entry that didn't get triggered in. I was already in the trade. It took me out for a 1% loss. Do I look at that trade, analyze it, and say, I shouldn't have taken that trade because of that one impulse? Or is that perfectionist mindset? I think it's a perfectionist mindset. And sometimes it's criticizing something or critiquing something like this and saying, I'm not going to take that trade, would be the same reason why I wouldn't take Pound Aussie and lots of other ones that go and make 7%, 5%, 6%. So you realize if you're constantly capping your risk at 1%, you're absolutely fine. And one impulse candle shouldn't put you off because essentially, how many things did we have? Maybe 5 or 6 confluences, but then we talk ourselves out with one trade. And we could argue that the Euro Kiwi trade is better than the Pound Aussie trade. This one didn't work out, but Pound Aussie did. Why is that? Well, Pound Aussie wasn't really at the top of a structure, it just had a double top, right? Just within a little pattern, and it came from a bull flag. It had an impulse and a bigger continuation that could have gone higher. What do we have here on the daily? Well, on the daily chart, we have this. We've got this structure where we know that this is the high probability at the highest level, right at the outer structure up here, which is a trade we actually went on to then take that banked myself 5% and a lot more in the community for others. So I took a 1% loss on this, which I was happy to take, and then 5% profit on the way down, so a net of 4%. But as you can see here, we've filled the wick, we have the double top, we've been moving up correctively for a long period of time. There was no reason why this didn't have to go to the top to drop. We've seen many that drop beforehand, understanding the probable and the possible. The probable, the possible. Going to the 1 hour, as you can see, corrective all the way through the 3-touch pattern, double top. You could argue this was a better trade than the Pound Aussie trade, but yet this one didn't work out and the Pound Aussie one did. So it's just about understanding those key differences there and realizing that if you're constantly put off by one little candle, then again, you'll forever be sitting on the sidelines. So a key difference there, and I thought that was a great example from side by side. Don't let the one impulse candle put you off, and just zoom out and realize that it's okay to take these trades, and you want to really highlight these trades, because if you get put off and then think, oh, I'm going to take that out of my plan now, that can send you in a downward spiral, not realizing that's fine. This is just probability playing out. So I hope that helps. And as you can see, overall, guys and girls, valid trade should really be an essential part of your plans. As long as you've got your ratios right and you're not just taking tons and tons of valid trades, you are waiting for a lot of high probability trades. You're not wrong if you take Euro Kiwi and it doesn't play out, because if you think you're wrong based off of this, you're not right or wrong, because it's about thinking in probabilities. Remember, get rid of you're right, you're wrong, because then you're not thinking in probabilities. And remember, you need to have 100% acceptance that a high probability trade doesn't need to play out 100% of the time. And if you're struggling with thinking probabilities, I highly recommend that you go and revisit chapter 7 in Trading in the Zone. Read that 3 times through, the 3-step process, and you're going to start thinking more in probabilities. So the key difference is some trades you can avoid, but then a lot of it is fear of missing out. And some trades are just down to probability. You can have your valid structures, you can have your valid trades, but you need to understand the key thing is having it in your plan. Rather than just taking these trades just because, it's an ascending channel, it's near that area, rather than just taking those trades for the sake of it, actually backtest it to your plan and realize, are you taking trades that are within that? And ask yourself, what do you think is stopping you from breaking through to consistency if you're not consistent yet? Are you just taking valid structures but not valid trades? Or are you just trying to catch lots of valid trades or way too many falling knives, hoping that one of those ones are going to play out? Because on the one that did make you 7%, you can't see thinking, that's fine, I'll keep trying to catch the bottom. That's fine, I'll keep trying to catch the top. And that one trade will make me, 9-10%. So it doesn't matter if I take 7 losses in a row. But the truth is that's unsustainable and very, very emotional. So make sure that you've got your ratios right. And a great little exercise to finish off this one, guys and girls, is make sure that you look through your last 10 trades. What I want you to do is look through your last 10 trades and actually mark on, is it 1, 2, or 3? The first part being, is it a valid structure but just not a valid trade? Where it's just not in any kind of area, you've just taken an ascending channel or a descending channel out of nowhere. Or is it a valid trade and a valid structure? So it's a good trade. Or is it a valid structure and a high probability trade? So what I want you to do is go through your past 10 trades or 20 trades and actually mark on how many of them are, so you can find your ratio. If you find that 50% of your trades are just valid structure, valid trades, and you're doing the break-even dance, or you're in the minus, you're only floating around 1%, then you might start to realize there you have your answer. The reason why you're not hitting the 5%, 6%, 10% plus figures per month is because you're either too zoomed in and you're just focusing on valid trades, valid structure way too much. Sometimes you need to take a step back and realize that staying out of the market is sometimes a profitable position as well. It's a very, very key lesson. But I promise you, once you get your ratios right and you can bring them to the forefront and realize, hold on a minute, this is why I'm not consistent. It's because 80% of my trades are just valid trades rather than the other way around. That key difference is going to help you out so much. And this exercise, we believe, is going to bridge that gap towards consistency. So I hope that helps. I would love to know your thoughts. And I cannot wait to dive into part 2, which is episode 5, where we go into more high probability setups and you can see the comparisons.